smoothing things out for investors. How does it work, and why is it a more favorable way to look at a portfolio than perhaps some people realize?
Well, it works because you're trying to build a portfolio of low volatility stocks. So you're not trying to find stocks that have low volatility, but you're trying to build a portfolio, and what that entails basically is finding stocks that have low correlation with each other. So think of a simple example. We have two stocks which have relatively high volatility. In other words, they move a lot, but they move it in a negative way with each other. So when one's up, the other's down. So that portfolio will almost never move in value. But because it's all invested in equities, invested in both those stocks, it'll generally go up as the company's earnings grow and as the economy grows. So the idea in the whole strategy is that rather than trying to find just safe stocks to invest in, you find good stocks, but you find stocks which aren't highly correlated with each other, or ideally have negative correlation, which is hard to do. And by doing that, you reduce overall portfolio volatility by of the order of 30 or 40%.
And so then what happens in terms of performance? Because a lot of your funds are basically measuring against the S&P 500, or you're trying to beat the S&P 500.
Right, S&P 500 or a global version of the S&P 500. What happens in terms of performance is in a normal market environment, you get market-like performance. In a falling market, you tend to do much better than the market. So for example, in 2008, when the market was down 40 and something, these things were down around 20, so about half as much. And when the market's up sharp, like in 2009, they tend to be up about 60% of what the market gets.